Hello, hello. Anyone ever watch Dutch Since? Very interesting YouTube channel. Check it out. Sinse Dutch. Dutch Sinse. Anyway, welcome to Scooby Algo Trades. Welcome back to another episode here. Hopefully the sound might be a bit better. I just stuck a little Bluetooth mic on here. See how it goes. I'm just going to use the same format as last time. I guess many people don't really watch this, and it's really just kind of recording my journey, I suppose. Um, I can make them more fancy, but this is just an update of how it's all going. Well, it's not really an update. It's more of something that I've been working on myself, and I want to get publicly documented today, which is the 28th of July, 2026. And I'll just do what the script says here. It says, the 3 ways I nearly fooled myself, a Scooby Algo Trades video script. So we're introducing something I invented, and I've checked this, by the way, so this is the real public record of it now. Not that I want anything for it, but just the recognition that something that I invented, right? So it's called the behavioral footprint trading, right? So I've been building a framework I call behavioral footprint trading, BFT. It's like the BFG, like the big friendly giant, except it's with a T, right? Like a tree, a big friendly tree. Think of it like that. But it's behavioral footprint trading, the BFT. I'm not going to explain it in the abstract because abstract explanations are exactly how bad ideas survive. Nobody can check them. Instead, I'm going to show you 3 times in the last week where I nearly fooled myself. Real ones from my own pipeline with the numbers, and I'll show you where the framework caught it and where it didn't. If you take one thing from this, every single one of these looked like a genuine edge right up until the moment it didn't. Part 1. What BFT actually claims. The claim is narrow, so let me be precise about it. When you're researching for factors, signals that predict stock returns, you can find patterns in almost anything if you look hard enough. Financial data is noisy and there's a lot of it. Search long enough and something will look predictive purely by chance. The usual defense against this is statistical. Out of sample testing, walk forward validation, multiple testing corrections. Those all matter and I use all of them. But notice what they are. They're filters applied after the search. You go looking, you find something, then you try to prove it isn't luck. BFT says, constrain the search before you run it. Only go looking for signals where you can name a persistent human behavior that would produce them. Not this pattern works, but this pattern works because people reliably do a specific thing. And here's why they'll keep doing it. I'll just say that one again because even that one has me tripping up here. Not that this pattern works, but that this pattern works because people reliably do a specific thing. And here is why they'll keep doing it. I think I said it better that time. So that sounds like an academic distinction. Here's why it isn't. Part 2, case 1, the sector filter. Now, chart 1, sector filter. Okay, so this is the filter. I guess. Is this chart 1? No, hold on. Let me get that for you. A second. Chart 1, sector filter. Coming up, coming up, coming up. It's there. Oh, it's not there yet. Is it there yet? Sector filter. There it is. Okay. I don't know how to zoom in on this. Hopefully you can see that. Sector filter, 2 sets, opposite answers. All right, we'll have a look at that now in a second. I run a factor model on New York Stock Exchange stocks. Standard setup that ranks about 900 names every week, and I track how the top of the list performs. I ran an alpha lens analysis on it. That's a standard tool that looks at how cleanly a signal separates winners from losers across the full history. It flagged 3 sectors where the model looked broken. Energy was actually inverted. The stocks the model liked the most fell the hardest. Communication services was negative across the board. Consumer defensive had no ordering at all. So I filtered them out. Obvious move. And the result looked great. The spread between the model's best picks and worst picks improved by 48%. That's the left-hand chart. Clear improvement. All right, left-hand chart. There's the improvement, 48%. Yay, right? Looks like clear improvement. Damage came from strong years, weakening, not from more losing years. All right, so little bar chart there for you. Visuals, since it's a video. So that's the left-hand chart, clear improvement. Then I ran a walk forward test, 17 folds spanning 2010 to 2026. Each fold trains only on the past and tests on genuinely unseen future data. That's the right-hand chart. The filtering version was worse. So there we go. You see, worse. The walk forward, 17 folds, train on past, test on unseen future. Filtering pushed it below significance. All right. See, red, bad. Okay. So that's the right-hand chart. The filtered version was worse. The T statistic dropped from 2.02 to 1.60, below the conventional significance threshold. The signal I just improved was no longer statistically distinguishable from noise. Here's the part that took me a while to understand. And honestly, I'm only starting to understand half of this even while I'm talking about it. This thing just moves so fast for me. But anyway, I'm trying to catch up. The damage didn't come from more losing years. It came from the strong years getting weaker. 2016 went from plus 38% to plus 32. 2020 from plus 15 to plus 7. So 2016 went from plus 38% to plus to, what does it say? That plus is messing me up. 2016 went from 38% to 32. 2020 went from 15 to 7, and 2023 went from 9 to half a percent. Those excluded sectors contributed. Those excluded sectors contributed real upside in specific years, even though across the full history they showed no clean pattern. A static snapshot averages that away. A walk forward test doesn't. Now, the BFT reading of this. I had no mechanism. I couldn't tell you why energy should be inverted. I observed it and I acted on it. If I'd made myself name a persistent behavior first, I'd have had nothing to say. The silence should have been the warning. It wasn't. The statistics caught it instead, and only because I bothered to run the harder test. Part 3, case 2, Oracle. So this is chart 2. I'll show you that now. Coming up, coming up, coming up. It's there. There it is. Oracle, the edge. That was a measurement artifact. Okay, so let me explain this one to you. Different part of the business. I built an option screener, and it looks for stocks where the options market is pricing in more movement than the stock actually delivers. Sell that gap, collect the premium. Oracle came up. Implied volatility, 63.7%. That's what the market expects. Realized volatility, 53.2. That's what the stock actually had been doing. Ratio of 1.20. The screener said 40% above fair value, best candidate on the list. So I went and read about Oracle. And Oracle at that moment had fallen from $149 to $115 in 3 weeks. Securities fraud class actions had been filed. A $40 to $50 billion debt raise was underway, 21,000 job cuts, regulators forcing a $7 billion collateral posting their AI data center bill. That elevated implied volatility wasn't mispricing. The market knew things my screener couldn't see. But here's the part I found genuinely interesting. Separately, and for unrelated reasons, I swapped out the volatility estimator. I've been using close to close, which only looks at closing prices. Close to close, which only looks at closing prices. See, I don't even know what the hell I'm talking about. I've been using close to close, which only looks at closing prices. I moved to Yang Zhang, I don't know if I'm pronouncing that right, Yang Zhang, which uses the full daily range, open, high, low, close. Same stock, same day, same option, but better measurement. Oracle's realized volatility went from 53.2 to 64.8. The ratio flipped from 1.2 to 0.98. The edge didn't shrink, it disappeared entirely. The better measurement independently reached the same conclusion the research had. That's the encouraging bit. But look at the order of events. That edge only ever existed because my measurement was crude. It was never in the market. It was in my tooling. So, excuse me, part 4, case 3, the filter that wasn't. So this is chart 3, the term slope. So I'll give you a look at this one. Coming up, there it is. The filter that was displayed but never applied. All right, positive slope, negative slope. All right. So this is the last one, and this is the most embarrassing. Calendar spreads. You sell a near dated option and buy a longer dated one at the same strike. The thesis is term structure. Near term implied volatility should be richer than the back month, and you're harvesting that gap. I built a screen for it. It computed term structure slope for every single, well, I didn't build it, AI did. It computed term structure slope for every single candidate, printed it in the output, every row. It never filtered on it. 20 of the 33 candidates in what the screener called the pure term structure list had positive slope, back month richer than front, the literal inverse of the thesis I was supposedly screening for. They were passing on something else entirely, and they were passing on something else entirely. Any at-the-money calendar spread looks cheap relative to its theoretical payoff because near-dated options decay faster than far-dated ones. That's arithmetic. Every calendar has it. It's got nothing to do with whether there's an actual mispricing. I only found this because the median slope across the list looked suspiciously flat, and I asked why. Once the gate was actually enforced, the list went from 33 candidates down to 13. And there was a genuinely useful finding underneath it. Term structure inverts hardest around earnings, which means a naively ranked calendar screen isn't a term structure screen at all. It's an earnings screen wearing a costume. Part 5. What this is for. 3 cases. Same shape every time. Something looked like an edge. In every case, the edge turned out to be an artifact of a static snapshot, of a crude estimator, of a filter that got displayed but never applied. And notice, none of these were caught by statistics alone. They were caught by asking, what's the mechanism here? What's the mechanism here? And not having a good answer. That's what BFT is for. It isn't a strategy. It's a constraint on what you're allowed to go looking for in the first place. Name the behavior first. If you can't name it, you're pattern matching and calling it research. I'm not claiming that's novel, by the way. Plenty of people say have a hypothesis first. What I'm trying to be specific about is what actually counts as a persistent behavioral bias, present in identifiable market participants, with the reason it won't simply be arbitraged away. Value works isn't a mechanism. Institutional mandates, forced selling at quarter end regardless of price. That's closer. I'll say that again. Value works. That's not a mechanism. Institutional mandates forced selling at quarter end regardless of price. That's closer. I don't like the way that's worded. I don't really understand that sentence, but if you get it, more power to you. But anyway, it needs to be more detailed, basically, I guess. Closing, right? Where things actually, but I did make this up myself. Like this is not AI's idea, it's my idea. And I'm sort of centering this whole thing around this idea. It seems like that's what I'm doing. I think that's what I'm doing. So anyway, here's the closing. Where things actually stand, honestly. New York's Stock Exchange signal has a T statistic of 202 across 17 out of sample falls. Hit rate 71%. Mean excess return of about 5.35% a year after cost. That's real. It's also modest. And it's the corrected figure. The number I was quoting last week, a week ago, was a bit higher. Yeah, because I recorded a video, didn't I? Yeah, that one was wrong, by the way. It was wrong because two of the factors feeding it had corrupted values that I hadn't checked. There's so many things that keep popping up all the time, kind of like bugs in the system. Anyway, it's in paper trading. It stays there for another 6 weeks minimum. The options screener has surfaced almost nothing tradable, given everything I've just shown you. I'm choosing to read that as a good sign. And that's BFT, behavioral footprint trading. It's not a system that finds winners. It's a system that makes it harder to lie to yourself. So production notes, chart 1 carries part 2, yeah, chart 3. So all numbers verified against, yeah, walk forward and all that. Okay, so yeah, hope you understand that. I hope you enjoyed that. I hope it makes sense. I hope you got something from it. A couple of charts there and everything. Did you like them? Look, visuals. All I do, animate them next time, something like that. Anyway, hope the sound quality was a bit better. I know I'm still just reading a script, but there we go. If you're interested in this type of stuff, you probably understood some of that. If not, you probably haven't got a clue. I haven't got a clue half the time, but anyway, we're getting there. So see you next time on Scooby Algo Trades. Bye for now. Scooby-Doo.